the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Hello and welcome to the Business Standard Banking Show. I'm Ishan Gera. In this episode, we will discuss the week's significant developments with a cover story highlighting the recovery in the banking sector and the road ahead. We have an interview lined up with K. Paul Thomas, MD and CEO of ESAF Small Finance Bank, where he talks about the upcoming IPO and recovery post-COVID. Our Banking for You section explains what bank frauds are and their impact on the system. And our banking expert Tamal Bandyopadhyay discusses the Chanda Kochhar case. At the end of the episode, we shall ask you the question for this week and discuss the results of the last week's poll. Earlier this week, the DIPAM secretary said that the government expects a good number of expressions of interest for IDBI. However, the important story for the week was the two reports released by the Reserve Bank of India. These reports inform us about the health of the banking system. While one highlighted that net profits for the banking sector have zoomed, the other indicated a further fall in non-performing assets. So what is the reason for this revival in the banking sector, and is it sustainable? We deep dive into this issue for our cover story. The turnaround story for 2022 has been the banking sector's revival. Net profits of scheduled commercial banks were up 40% in the second quarter of 2022-23 compared to last year. In fact, as per Business Standard analysis, the share of banks, financial services, insurance and stockbroking or BFSI in overall corporate profits hit a record high of 41.5% during the second quarter, double its historical 10-year average share of 21.8%. The fact was further cemented by two RBI reports released last week. One of them, the report titled Trends and Progress of Banking in India, showed that banking sector has moved from loss to profit over the previous 5 years. Moreover, the Financial Stability Report showed that gross non-performing assets called GNPAs or bad loans had declined to a 7-year low of 5%. Until 3 years ago, NPAs of scheduled commercial banks were over 9%. Net NPAs in September were at a 10-year low. The RBI report highlights timely policy support cushioned the impact of pandemic on banks' financial performance and soundness indicators. This has been accompanied by lower slippages and the bolstering of capital buffers. But to understand what this means, let's go to our banking editor Manojit Saha.
The public sector banks were having a disproportionate share of bad loans. With the support of the capital from the government, banks were able to make provision for the NPAs. As a result, gross NPAs peaked in March 2018. Since banks were mainly focusing on retail loans in the last few years, new NPA creation or fresh slippages was contained. Now that the provisioning part is over, with loan demand coming back, banks are able to improve their profitability.
Although banks have had adequate capital to deal with the crisis, can they weather the upcoming storm, especially as interest rates rise? More important, can they sustain their performance? While both reports highlight growing risks from rising interest rates and global headwinds, they do point out that counterbalancing effect may help banks sail through. The mark-to-market losses may be covered by the rise in interest margins as most loans are external benchmark linked. The Financial Stability Report goes further to say macro stress tests for credit risk reveal that SCBs are well capitalized and all banks would be able to comply with the minimum capital requirements even under adverse stress scenarios. But can they sustain the current performance?
We have a positive outlook on the banking sector. So even for FY24, we expect ROAs to improve by about 10 basis point, 10 to 15 basis point, and credit growth to move from 13 to 15% in FY23 to about 14 to 16% in FY24. But there are some risks that also remain in the system. Few macroeconomic risk is increase in interest rates, If there is some issue in the financial system globally because of that, we could also be impacted. Two, three other macroeconomic reasons are geopolitical events, global recession, and COVID impact. If we come to risks on the industry side, banking industry specific, then increasing competition and higher share of unsecured loans could be a problem going forward.
The immediate challenge for banking sector is to shore up deposits. Asset quality may not be an issue for now. Banks may be resilient to a crisis, but profitability will depend on managing credit. Can profitability lead to more risk-taking is what remains to be seen. Empirical estimates show that net interest margins need to cross 5% threshold for bank profitability to turn detrimental to financial stability. By end March 2022, the NIM of scheduled commercial banks was 2.9%. A fall in NPAs and lower provisioning has helped banks tide over the pandemic. Robust credit growth has further provided a fillip to bank balance sheets. It is not just the scheduled commercial banks which have performed better. Small finance banks are also coming of age. They're competing with their larger peers for deposits. I discussed with K. Paul Thomas, MD and CEO of ESAF Small Finance Bank, on the post-COVID recovery, IPO plans, and portfolio diversification. ESAF, which operated as a microfinance institution, was among the first ones to receive a small finance bank license. As the banking sector is roaring, ESAF is in the process of refiling its draft IPO papers. We have with us K. Paul Thomas, MD and CEO of ESAF Small Finance Bank, to discuss the IPO plans and the road ahead. Welcome to the show, sir.
Thank you.
Mr. Thomas, my first question is, you are in the process of refiling the draft IPO papers. Can we expect a listing in the second half, or are you looking at 2024 for listing?
We are in the process of refiling our papers with SEBI. So we are expecting to complete it by the second quarter of this next financial year. So that's a plan.
Small finance banks are offering more attractive FD rates than universal banks. Wouldn't this put a pressure on the margins?
There is an historical background. Most of the small finance banks were NBFC MFIs. So when we started, our liabilities were mostly from bank borrowings before we convert to a bank, and we had a pressure to refund. Close all our grandfather loans within 3 years. So when we started, we have offered a higher interest rate. But even then, that was below the rates where even in case of ESAF, we were borrowing from banks and other financial institutions. So that's number one. So then if you see the last couple of years, that SFBs have reduced the FD rates. And when all the other universal banks have increased the rates, we have seen that. So the margins on the difference between universal bank rates and SFB's rates, and now that it has come down, it has narrowed down. And again, why we are able to afford this? Most of us have SFB, especially in ESAF. Also, our asset class is mainly on microfinance, and it gives a higher margin. So margins are not much affected because it is compared to the rates we were borrowing, it is less. That's why we were able to offer. But over a period of time, the rates have come down.
Scheduled commercial banks have performed well in the first half.
Yeah.
What has been your performance like? What is the credit growth like, and can it be sustained?
Yeah, we also have performed reasonably well during the last 6 months. So, and we are confident of sustaining our growth in the coming months and coming years. We are very confident because we see a lot of market opportunity in front of us. Because considering the economic growth India is targeting, the rural and semi-urban areas play an important role, but the credit outflow to these rural semi-urban areas is only less than 10%. And ESAF Bank, we have 70% of our bank branches are located in rural and semi-urban areas, and we have got long experience in working with the customers in from these regions. So we see a lot of the credit growth will happen in these markets, and our experience in working with these segments, rural artisans, weavers, farmers, micro entrepreneurs, all will give us an edge over other universal banks.
Net profits were in triple digits. The growth of net profits was in triple digits last year. Can we see something similar in this year as well? One. Two, regarding credit growth, what has been your credit growth like? Because the system has grown at 18%.
Yeah, so last couple of months we were focusing on our asset quality improvement. So we were also on the microfinance side. There is a new guidelines were to be implemented. So we have slowed down our credit growth during the last 9 months. Actually, we have grown only 10%. But in the last quarter, this current quarter, we will definitely will be growing, and because the systems and everything is ready, and asset quality also improved a lot, so that we will be growing. On a profit side, we are expecting the previous years.
Full recovery post pandemic, or are there segments which have still not taken off?
Yeah, there are some segments actually. So we major 79% of our assets are today in the micro loan, and majority the fishermen community, the artisans, farmers, weavers. So some of them have some areas still have there are some issues, especially the cyclone affected. Again, it has impacted, but otherwise generally it has come back, and we are close to the pre-COVID levels. So by March, we will be closer to the pre-COVID levels. Except a few areas, in all other places, we are back to the collections are back to normal.
Even the collection efficiencies are back to normal. Is that what you're saying?
Yeah, back to normal, but not up to the pre-COVID level. Pre-COVID levels will take another 3 to 4 months.
While you've expanded, you are still a niche segment player. Are there plans to enter into new geographies and diversify away from MFI loans?
Yes, definitely. So when we started, we were 100%. Our assets were 100% in microfinance. So today, if you check it is, we brought down to 79%. So the product diversification is happening. So we have introduced gold loan. It is 10% now, 10% of the book, and we have introduced agri loans. It is growing. MSME is growing. Mortgage and mobility loans, all we introduced during the last 5 years. We built teams, and so all this. So over another 3 years, the micro loan concentration will come down to 60%. So, but we will continue to serve the bottom of the pyramid segments. So without losing that focus, we will grow the other books. That's the plan. And on a geographical concentration also, when we started, we have presence only in 10 states. So today we are present in 21 states and 2 union territories, and we are opening more branches in the new geographies, especially UP, Rajasthan, Haryana. These are the states we will be opening more branches. So we are definitely on the geographical concentration, product concentration. We have already addressed, and in 2-3 years we will see the results.
Perfect. It was great talking to you, Mr. Thomas. We hope to talk to you again soon, probably after you file your IPO papers and come into the market. Thank you. Thanks a lot.
Thank you. Thank you very much. Thank you so much. Thank you.
Thomas says that certain segments are yet to return to pre-COVID levels. He also highlighted that collection efficiencies would take 2 to 3 months to reach the pre-COVID level. Meanwhile, another pressure on banks is the rising compliance costs due to cybersecurity concerns. The latest report on trends and progress of banking in India by the Reserve Bank of India showed that bank frauds are on the rise. But what are these bank frauds and how do they impact the system? Let's find out in our Banking for You section.
Frauds continue to be a deadweight on our banking system. The Reserve Bank of India's report on the trend and progress of banking in India 2021-2022 says that card or internet-based transactions are rising. Additionally, cash frauds are also on the rise. The number of fraud cases reported by private banks was more than that by state-run banks for the second consecutive year in FY22. In terms of the amount involved, the share of state-run banks was 66.7% in FY22 compared with 59.4% in FY21. With capital going at a premium, the system can ill afford vast sums getting locked in frauds and its provisioning at the expense of shareholders and depositors. It might be recalled that the number of bank frauds in the first half of FY22 fell dramatically to 36,342 crore rupees from 64,261 crore rupees in the year-ago period. But there was no escaping the fact that the banking system saw frauds of 100 crore rupees per day over the past 7 years. As Minister of State for Finance Bhagwat Karat told the Rajya Sabha in a written reply in March last year, the RBI's annual report for 2020-21 notes that the average time lag between the date of occurrence of fraud and its detection was 23 months. For large frauds, which is 100 crore rupees and above, it was 57 months. A two-decadal analysis by the Financial Stability Report of June 2019 found that frauds between FY1 and FY18 constituted 90.6% of what was reported in FY19 by value. The subcommittee of the Financial Stability and Development Council at its meeting on September 27, 2019, chaired by the RBI Governor Shaktikanta Das, discussed measures to strengthen the system against fraud and to revisit the framework for early warning signals. But sterner measures may be needed.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
The number of fraud cases reported by private banks was more than that by state-run banks for the second consecutive year in FY22. In terms of the amount involved, the share of state-run banks was 66.7% in that financial year. Frauds are the focal point of the banking sector discussion these days, and the arrest of former ICICI Bank CEO and MD Chanda Kochhar has brought the focus back to the fraudulent loan grants case. We chatted with our consulting editor Tamal Bandyopadhyay to understand the issue. Hi Tamal, thanks for coming on the show.
Thank you, Ishan.
Now, you have discussed the Chanda Kochhar case in your column this week, laying a clear timeline of the events. One, we would like you to lay down that timeline for our viewers in a concise manner. But the part that I found interesting was the fact that investigating agencies have failed time and again to bring these cases to conclusion. What, according to you, is the reason for this failure?
There is only one reason. Our investigative agencies are not exactly well equipped to handle such cases in the financial sector. If you look at the cases in the banking sector, irrespective of the nature of the case, whether it's in the public sector banks or private banks, whether the fraudsters have left the country, living somewhere else, or within India, the record says that our investigative agencies have not been able to establish the culpability. I can think of Gopalakrishnan in the 90s, who was involved in some scam in Indian Bank. In the recent past, there have been many cases where particularly public sector bankers, senior public sector bankers, with a lot of drama, they faced CBI with that quintessential quote, "You are under arrest." and thrown into jail. And they had to spend a fortnight or more in jails. But what happened? Have the cases gone anywhere? No, because it's very difficult also in banking. It's a commercial decision. I mean, unless you really have that kind of expertise, which our investigative benches don't have. So that's the main reason. Other factor, of course, probably, it's a kind of adventurism, what do I call, to scare them, to create a fair psychosis that the bankers would behave well. Probably that's how the trend started.
You say that there was quid pro quo in one instance, so there would have been in others as well. But this is the one that's been proved. So isn't that the case for culpability?
Has it been proved? Who says that it has been proved? It's the allegation at this point of time. It's an allegation. If it had been proved, then they would be sent to jail. I mean, they will be sentenced. So there's nothing. They have not been convicted. It's not been proved. What I essentially said is this: the entire Indian banking industry has lent to Videocon. ICICI Bank's exposure to Videocon is less than 10% of the industry. So if there had been a quid pro quo in this case, which has been alleged, then how would the other banks given money to Videocon? Now, if Videocon could get money from other banks without any kind of under the table arrangement, why would they have gone for quid pro quo in this case? I'm just playing devil's advocate.
Mm-hmm.
I'm not saying that Ms. Kochhar is absolutely innocent.
I would like to take you to another aspect of this. Has there been any learnings from this episode as far as corporate governance is concerned?
There was a fear psychosis among the banks, and the government went out of its way to actually put them in ease. You remember there were at least one meeting where finance minister called CBI chief also, and jointly they addressed the bankers. So there was a fear psychosis, but now slowly it's been receding, and the credit offtake in the current year shows that. So what happened is, yes, banks, risk management, banks, underwriting capabilities, etc., have definitely gone up. And I would like to believe the boards are also much more vigilant than what they were, particularly in this case. And you have raised a very, very valid point that the role of the boards is very critical. I mean, how could, in this case, the board went out of its way to defend Chanda Kochhar? Even a former chairman of ICICI Bank came on television channels in her defense. So, I mean, how do you defend? How do you explain that? The role of the board is very, very critical. But under the Banking Regulation Act, ultimately in the private sector banks, the buck stops at the MD and CEO. Having said that, RBI needs to be more vigilant about the selection of directors of the board. I mean, it can't be just tick mark. And probably also we need to look at this. I don't know whether the Companies Act needs to be fine-tuned or whatever. The fixing the responsibility of the boards also. The Companies Act 2013 have done that. But I think we need to do more in the cases in banking where we find that board keeps its eyes closed. And that's not only the case in ICICI Bank. There have been a few other cases as well where we found that board is not exactly as vigilant as they should be. And what Reserve Bank of India does is typically one fine morning you'll find one RBI representative gets into the board as a director. But that's not the answer. That's a sort of band-aid approach to address the issue. But you need to address the issue at the root.
Two RBI reports highlight the resilience of the banking sector and its performance. Will the banks be able to perform as well as they did last year? And does that hold true for NBFCs and other banking entities as well? What, according to you, are the weak links in the sector?
Well, if you are referring to the two Reserve Bank of India reports, and they have been giving good certificates to the banking system. They are well capitalized. Even in the worst scenario, they would not fall short of capital. and B, the pile of bad assets have gone down. It's a decadal low. Yes, there are two important things the bank need to watch out for. One is the deposit growth. Not every bank will be able to handle the credit growth because their deposit is not growing. Theoretically, of course, they can liquidate their excess government bond holding and generate liquidity to support credit growth. Also, they can raise money from the market in the form of capital. But everybody cannot go to the market and raise capital. And everybody does not have excess SLR holdings, right? So the deposit raising is a big challenge for the banking sector at this point of time. And second is, again, we are seeing the hard mentality. Typically, one bank goes and gets into lends to some entity, and the other banks also chase and do the same thing. Has that trend started? Probably yes, even though in a little mild manner. So, like for instance, everybody chasing retail assets, but does everybody have the expertise?
Thanks, Tamal. Thanks for coming on the show again. We hope to see you next week again. Thank you. Tamal carefully lays out the details of the case and explains the whole process. He also discusses the road ahead for the banking sector. Last week, we asked you about another issue that has riled up the banking sector: cryptocurrencies. While the RBI governor has categorically come out against cryptocurrencies, the government's stand has not been clear. Our viewers, though, were as clear about cryptocurrencies as the RBI governor. 67.8%, or more than 2/3, said that the government should ban cryptocurrencies altogether. This week, we want to draw your attention to the insurance sector. The government has been discussing a composite license, and LIC seems interested in the business. A composite license would help Life Insurance Corporation to leverage its network and diversify faster. We discussed composite licenses in a cover story a few weeks ago. We want to understand how you feel about it. Should LIC venture into non-life and health insurance businesses? Our polls open on Friday, and you can respond on Twitter, Instagram, LinkedIn, Telegram, YouTube, and our website. We'll be back next week with more news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.